Good morning, good afternoon, good evening, folks. Michael Zuber, one Ritzel at a time. It is Wednesday morning, and that means she is back, the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Always doing great on Wednesday mornings when we get to talk.
Oh, I appreciate it. Yeah, the audience loves you. 3 years of dedication. It's just so wonderful you coming back each and every week. Do me a favor and remind people where they could be following you, because something you've taken great care, probably purposefully, but I've definitely noticed it over the last 6 months, to put out well thought out, frankly, lengthy posts, because the topics you are tackling need that level of depth. In I believe it's all on Facebook, maybe elsewhere. But recently you just did a post like the last 24 hours about it, thinking like an investor, understanding how the big investors play, and then, doing risk and opportunity costs. So remind them where they can find all this great stuff. And then let's talk about the post.
Great. Thank you so much. So I post mostly on Facebook, also on LinkedIn. You can follow me there at Anna Kelly, REI Mom. And if my friend list doesn't let you add me, you can go to my page, Anna Kelly, REI Mom. And yeah, Michael, like we do on this show, really, both of us have a heart to help educate investors, because real estate is not necessarily easy. Sometimes it's easier than others, like in the last decade or so. But when things start to shift in the economy, most people really don't know what to do and kind of get paralyzed with fear, right? We've talked about the fear in the marketplace when things change rapidly, and they don't know how to move forward. And so, we've talked a little on this show how I was blindsided by 2009, even working for AIG, being in private banking, understanding investments, starting in real estate, and it still completely blindsided me because I didn't know how economic risks in the system could impact our returns beyond what I did to make my properties worth more. What type of advice I followed to pick the right, mutual funds in my 401k. And so I did have the wherewithal that, thankfully, starting in private banking, I learned what do wealthy investors look for and how do they evaluate investments and what they're going to choose to invest in to move the needle on their financial goals. So as we're shifting, and there's a lot of different changes that are impacting negatively many different asset classes, right? From single family homes to vacation rentals, multifamily homes, bonds, stocks, equities, just about everything. We've had this big asset bubble where assets have risen almost unsustainably, right? With the cheap debt that we've had. And now we're seeing many assets have the risk of really rapidly devaluing. So my post today really was talking about how do investors evaluate different types of investments to go into at any time in the markets. And then once you understand that a little bit, then it's much easier to say, okay, what are the risks in today's market that are shifting some asset classes to be riskier than others? So I'll stop there, see if you have any questions for me, and then I'll kind of tell you what I'm thinking.
Yeah, so I think there's so much there. And again, people, they really should be following you if your friends list will let them in, because, and oh, by the way, if you haven't followed her, you should go back months and just read these posts, because there's all so much gold and gems in those. I think for me, there's a couple of ways to look at this. Most investors, myself included, I think need to focus on a single asset. We sometimes get very distracted, right? I'm a real estate guy. Oh, I'm going to do self-storage. Oh, I'm going to do crypto. Oh, I'm going to do, S&P dollar cost averaging or whatever. In the beginning, before you've got a big stack, I think there's more benefits in focus. But sometimes that focus actually becomes a problem. And let's just talk about real estate, or let's talk about multifamily, right? Over the last couple of years, value add, multifamily the big stuff, it's had the wind at its back, right?
Yeah.
Interest rates were going down, more and more lending options, bridge. I mean, it was the perfect time. And there's a lot of people that made a lot of money.
Yes.
However, when the market pivots, sometimes the operators who had the wind at their back for a couple of years and haven't experienced a pivot before can be surprised. It would not shock me if cap rates go up. It would not shock me if expenses go up. It would not shock me if vacancies go up. It would not shock me if collection. I mean, it could go through the parade of terribles in this space. It will get better, but you can't be 3 deviations away and not eventually regress to the mean, I wouldn't think. So yeah, I think there's a lot to talk about with kind of risk, understanding that when markets change, you should change. So
yes.
That's what
Yeah.
I was thinking.
Yeah, no, I think that's a great point. So before we kind of delve into, evaluating different investment options, in terms of what you do as your main thing, you're best suited to keep your main thing, and then adjust to figuring out what risks are there today in your main thing that you might need to mitigate or change a little bit to maintain your preservation of value, to maintain the income, just to kind of get through the storm that we're in, undoubtedly, and what's ahead, regardless of which way it goes, right? If we have mass inflation or mass deflation, both are truly options depending on many other macroeconomic factors, right? So don't go out and sell everything and then try to become an expert in new investments that you don't understand the fundamentals yet, much less the risks and how they change. But with that said, as we grow as investors and as we grow our wealth, there's no more important time for our overall investments, our overall income stream, to have some level of diversification. So if your one chosen asset class or your one chosen market that you're investing in is really hit hard, you don't have 10 or 50 properties in that one market that are all hit hard at the same time, right? It's why if you listen to previous shows we've done, I sold a bunch of properties in central Pennsylvania, and I started syndicating outside of my market in Atlanta, Georgia, and Houston, Texas, Dallas, et cetera. And I started buying more vacation rentals just because it gave me a different kind of risk. But the other thing is, the vast majority of you listeners out there probably have a few properties, but you've got 401ks, you've got maybe self-directed IRAs or 401ks where you can invest in other things, but you can't own it yourself, right? You have to invest essentially passively in a lot of things. And so many of us have investments outside of our one type of property that we're looking at. And we need to kind of figure out, if we had to sell our properties, right? Would we have to sell at a loss? What else could we put our money into if we sold, for example? And so we have to think about, what will my property be worth in the future, in the next 6 months, the next year, the next, 5-10 years? And do I think that I can realize the upside I'm hoping for? And if not, can I keep those properties and maintain the cash flow? And can I take advantage of buying properties that I consider really cheap in the next year or two, and kind of try to figure out what they might be worth a few years later? So as an investor, no matter what we're investing in, the way that we evaluate whether an investment is good should be beyond just what's real estate worth today, what's the income going to be. We have to say, what are the factors that influence two things: the risks and the opportunity cost, right? So the first thing, let's talk about risk. When we buy real estate, just to simplify it, we are essentially buying a future income stream, and we're buying a future upside for growth and appreciation, right? We want equity, we want income in some capacity. Oh, by the way, we have tax benefits and, all of those great things. But essentially, for us to determine whether an investment is really good, we have to say, what are the factors, the inputs in my calculations for income and in my calculations for equity growth, whether that's appreciation, forced appreciation, et cetera. And what are the factors today that can change those numbers to either make the investment get better or to make the investment get worse? So I have to understand, at least at a fundamental level, whatever asset I'm investing in, what are the things that are going to impact my ability to continue to generate those returns? How can I then mitigate those things, make them better, so that no matter what happens in the probability of those risks materializing, I'm still managing my asset in a way that's profitable? And then the second piece of that is, what's the opportunity cost of buying this property today, the single family home in Fresno versus the 4-unit property in Hershey, Pennsylvania, versus a passive investment, in a syndication, in Georgia, right? And so you have to understand risk and opportunity cost in order to really be a strong investor that has confidence that what I'm buying today, I know I can steward and manage to create additional income and wealth over time. And I'm making the best opportunity I'm making the best use of that money to capitalize on this opportunity rather than shifting and buying something else. So I know that's a lot to unpack, but let's kind of start there.
I think that's exactly right. And I think we will tie this into video number 2, because we're going to talk about the Fed and their aggressive stance. When I look at this and think about risk, opportunity cost, what's really transpired over the last, let's call it 90 days, is the risk-free interest rate has
Yeah,
changed, which fundamentally changes everything, right? When risk was,
absolutely.
risk was essentially 0 or 0.5%, you get asset bubbles, right? You get, the in bubbles everywhere, or whatever that's called. And now it's 4%. It hit the 10-year note hit 4% for a second yesterday. 4%.
Absolutely. And that is extremely important for people to understand. People think interest rates went up. What's the big deal? They're still lower than they have been in history, right? But it's not so much where the interest rate is, it's the level of change and how quickly they change, the velocity of the change, where in addition to the risk-free rate of return, which is considered historically the US 10-year treasury rate, right? If that was between 0.5 and 2%, that's considered the risk-free rate of return. So investors could park their money in a treasury and theoretically have no risk, right? Because it's backed by the full faith and credit of the US. So if hedge funds that are having to pay a 4% pension, to their pensioners need to make 5 in order to pay that 4% pension, they can't invest in a US Treasury. So they need to go up the risk ladder and say, I need something that'll pay me 5. Well, what options are out there that'll pay 5 compared to a Treasury? The risk ladder usually goes something like this. You have the US Treasury, then you have municipal bonds that might pay 3 when a Treasury's 2. You might have a AAA bond that pays 4 when a Treasury's 2. Then you might go to commercial real estate, big Class A multifamily that pays 5 when a Treasury is 2. Or you go to the S&P and you hope for 8 when the Treasury is 2. So as you need higher returns, you have to make, more risky investments to get there. And so since the Treasury's been so low, institutions, mutual funds, hedge funds, insurance companies, investors like us say, let's take a little bit more risk. But not only that, we've been given super cheap debt that's allowed us to fund it and well exceed those cash on cash returns if we had invested with cash. And so your cap rates when interest rates are low and treasury low can stay really low. And cap rate low means value high. So it's created 10 years of these asset bubbles where we've used really cheap debt and we've been able to make our properties worth a lot. Well, when that treasury goes up to 4, which it hit yesterday, right? You've gone up 2 to 3.5% over, what we've seen in the last decade. The risk difference that I just talked about, 1% for AAA bonds, 2 to 3% for multifamily Class A, maybe 4% for single family, those risk premiums are still the same. So now you need to bump up the rate that you demand for that money for the risk above 4 instead of for the risk above 2. And as investors say, wait a second, why would I buy a Class A multifamily building at a 4 cap that has a risk of not filling it, tenants defaulting, whatever it is? It's considered pretty low risk. It's in a great market, et cetera. But if I can park my money for free in the US Treasury with no risk, then in order for me to buy that Class A multifamily property, I'm going to demand a higher cash on cash return. That's going to make the cap rate in the market say, wait a second, we've got to adjust. We want at least maybe 5 or 6, depending on where it is, supply and demand, all those other factors that take into account. But that means that values will come down simply because the risk-free rate of return has gone up substantially. And so that's what we're watching. And especially in commercial real estate, there's ways to mitigate it, right? So this isn't to create fear. I'm a multifamily operator and I'll continue to be a multifamily operator and syndicator. But you've got to make sure if you're investing in those things actively or passively, you understand and your operators understand what are all the components that impact their value, both the net operating income, or taxes and insurance and expenses going up. Can I raise rents to keep up with it? And the valuation on the back end. So it's fundamental that you start thinking like an investor, understanding your risks and how your risks go up when the risk-free rate of return goes up and there's economic instability.
With that, we're going to leave video number 1 here because we're going to break down that the Fed is basically focusing value and risk and all of that in video number 2. Again, they're going to go higher for longer, quicker. So that's going to impact a lot of stuff. That will be video number 2. Anna, where can people find you?
Great. You can find me here every week and on my playlist on your channel. We have years of really great content talking about amazing things about real estate and the economy and how to get ahead as an investor. You can find me on social media, as we talked about, on Anna Kelly, REI Mom, and my website is reimom.com.
Awesome. Thank you so much.
Thanks.